Let's look at some liquidity ratios now. Now, liquidity is all about short term. Can you basically pay your bills in the short term versus, let's say, some of the debt ratios, which might be looking at longer term and longer term debt. But liquidity ratios are all about how liquid is the company, what is its ability to make its payments and service its debts in the short term. And one of the most common ones in the liquidity ratios, and one you want to look at, is the current ratio. That's probably the one that's used almost the most, along with the next one we'll learn, is the current ratio. And you get the balance sheet, and that's where you can easily see it really from the balance sheet. It's a very easy formula. You're looking at your total current assets divided by current liabilities, right? Assets are things we own, factories, equipment, whatever. And liabilities are things that we owe people. We need, short-term payments, that kind of stuff. We're looking at our current liabilities that are out there. Maybe we owe money on a lease or something like that. So that's liabilities. So with the current ratio, what you're looking at, you're measuring a company's ability to pay its short-term liabilities in comparison to its short-term assets. So you're really looking at short-term assets, short-term liabilities. That's the current part. The current assets are current liabilities. But once again, you don't have to calculate that. Just go look for companies. They'll have in its statements and things its current ratio. You can find that pretty easily. And the idea is if the current ratio is over 1 as a numeric, that means the firm or the company has more assets than liabilities. It has the assets to pay its short-term liabilities. I mean, worst case, that means it could sell all its assets, take that money and pay all its short-term liabilities and make it that way. Now, you never want that, but that means it's not really insolvent or in trouble. It means it has the ability to make its current payments. That's very important from a long-term view of a stock, but also short-term. Companies that can't make their current payments, their stock prices go down pretty fast because people get worried about that company. Are they going to make it, or are they in trouble? So ratio over 1 is good, and the higher the number, the better when you're comparing it. If it's less than 1, that means its liabilities are higher than its assets, at least from the current aspect. That doesn't mean they can't continue to service those liabilities. They got cash coming in, or maybe they got long-term debts that are coming off the books, and they can then funnel that cash, or they're taking on more long-term debt just to meet its short-term obligations, or borrowing money from a bank to meet short-term obligations. So you can do things to keep solvent, but aren't those kind of not great things? You don't want to take out more loans to service short-term debt. If you're going to take out a loan, you want to use that to fund long-term, bigger growth type opportunities, not to service short-term debt. So when you're looking at companies, look for anything that's got a 1 or higher, and the higher the number, the better. But if it's below 1 in its current ratio, be a little bit more cautious on it. Really dig in deeper in that company and see if there's anything that might be problematic on the horizon, particularly for the industry as a whole, or that company in particular, because a short-term shock to the system in the industry or that company, if they're having a below 1 current ratio, that means they could be in trouble real fast. So if you want a riskier stock, then look for something with a low current ratio. But over 1 and above, that's a little bit more solid of a stock, meaning its current ratio able to make its current payments.